Great. Let's unpack this. We are diving deep today into one of the most powerful and, often misunderstood concepts in all of economics, opportunity cost. It's the true sort of hidden price tag that's attached to every single decision you make.
Every single one.
Oh, wait.
Doesn't matter if you're running a Fortune 500 company or, like you said, just deciding what to have for dinner. It's always there.
Right. Because when most of us talk about cost, we're really just focusing on the explicit price, the actual cash that leaves our wallet. But the economic reality of limited resources dictates that every choice, by necessity, involves a sacrifice.
It has to.
Our sources today, and we've looked at everything from foundational microeconomic texts to contemporary articles on global trade and even health policy, they all emphasize the same fundamental idea.
And what is that idea?
That given scarce resources, when you choose one alternative, you are actively, by definition, losing the benefit of the other options you didn't choose.
Yeah.
So opportunity cost is formally defined as the value of the best alternative forgone when a choice is made between several options.
And that framing is so crucial. It really is. It's where a lot of people stumble at first.
How so?
Well, if we assume, as economists generally do, that you're a rational actor trying to make the optimal choice.
The one that gives you the most benefit or utility.
Exactly. Then the opportunity cost isn't the cost of all the other choices combined. It's the cost you incur by not enjoying the benefit that was available from your second best choice.
Right, so it's not the cost of everything else, just the value of the single most attractive alternative that you had to walk away from.
Precisely.
So if I have, say, an hour of free time, and I can either read a book, which is option A, go for a run, option B, or clean the garage, option C.
And let's be honest, cleaning the garage is probably option C for most of us.
Right. So let's say reading the book gives me the highest utility. I value that the most. But going for a run was the next best thing.
Okay.
Then the opportunity cost of me reading that book is the health benefit and the stress relief I lost by not going for that run.
Exactly. And that brings us right to the core issue of scarcity. The moment resources are limited, and all resources, including our time, are limited, you are forced to choose. There's no way around it.
And the whole point of calculating opportunity cost, then, is efficiency.
Purely efficiency. Whether it's in a massive corporation or just in your own home, it's a mechanism. It's a tool to ensure the most efficient allocation and use of those scarce resources.
Because if you pick option A, but the benefit you lost from option B was actually higher, you've made a bad trade.
You've made an inefficient choice. The cost was too high.
And we really have to underscore this point right now. Opportunity costs are not just about money. They are not restricted to monetary or financial costs. We're talking about all associated costs.
Absolutely. I mean, this is the fundamental difference between simple bookkeeping and true economic analysis. We're talking about explicit costs, the cash that actually moves, but also implicit costs.
And that's the tricky part.
It is. Because implicit costs cover things like lost time, lost pleasure, lost potential income, or any other non-monetary benefit that provides you with utility.
The fact that opportunity cost lets us quantify these intangible trade-offs, that's what makes it so vital, isn't it?
That's the power. It gives you a comprehensive metric of the true sacrifice involved in any decision you make.
And if we really start thinking this way, everything changes. Choosing to spend an hour on, say, professional development instead of high-value client work, that incurs an implicit cost.
A huge one. It's based on the income you just lost.
Or if you choose a long commute to live in a bigger house, the explicit cost is the gas for your car.
Sure, that's easy to see.
But the implicit cost is the 2 extra hours of free time you lose every single day that you can never get back.
And those implicit costs often compound over time, which can make them far, far more significant than whatever initial cash you laid out. To truly calculate if a decision is sound economically, you have to recognize the anatomy of cost itself.
Okay, so let's break down that anatomy now. Let's move beyond just the definition and into our first segment. The dual nature of costs explicit versus implicit.
Sounds good.
Let's start with the one that's easier to grasp, the one that, gives accountants peace of mind.
We can start with explicit costs. And they are, as you say, straightforward. These are the direct, out-of-pocket costs of any action.
So tangible.
Always. They always involve a dollar value or some clear transfer of money.
These are the costs you can spot immediately on an income statement. Things like operational expenses, wages, rent, overhead, utilities, raw materials.
Right. They're the costs that hit the company's bank account directly. They're simple because they're transactional. You have a receipt for them.
So let's use that scenario from our sources.
Hmm.
Imagine an employee leaves work for 1 hour to buy, say, $200 worth of office supplies.
Okay.
The explicit cost here is totally transparent. It's the $200 cash spent on the supplies.
Right. And maybe you could add the explicit cost of the gas needed for the trip. But it's a recorded cash outflow. You can track it.
Or another one, a classic business headache, a malfunctioning printer. The explicit cost is just the total amount you paid directly to the repair technician for their parts and labor.
You can point to the invoice and say, that is the cost. And that is precisely why standard accounting practices love explicit costs. They're verifiable, they're easily auditable.
And they provide a clear fiscal record of the firm's cash flows for reporting.
But, and this is a huge but, relying only on those explicit costs gives you an incomplete picture, and often it's a dangerously optimistic picture of the economic reality.
Because to understand the true cost of that choice, we have to flip the coin over and look at the implicit side. This is where the economist steps in, right?
Exactly. And what's so fascinating here is how these implicit costs, which are also sometimes called imputed or implied or even notional costs, are often hidden in plain sight.
Okay, so define it for us. What is an implicit cost?
By definition, an implicit cost is the opportunity cost of using resources that are owned by the firm or the individual. Resources that could have been used for other profitable or utility-generating purposes.
So the moment you call them notional, you're stepping away from something tangible.
You are. Since these costs don't involve an immediate cash exchange, they've already occurred within a project without a transaction. And for that reason, they're generally not recorded for standard accounting purposes.
Oh, because there's no cash flow.
No cash flow. But they represent a significant loss of potential value.
What are some of the primary examples?
The biggest ones usually center on resources contributed by a business owner. Their own time, their own labor, the use of their personal infrastructure.
Like using their own car for deliveries.
Exactly. Or the implicit cost of the risk they're personally bearing. And a critical component is just the time spent. Every single moment you invest in one activity is a valuable activity forgone. We also have to include the depreciation of owned goods, materials, and equipment.
How is depreciation an implicit cost?
Because the asset loses value over time. That's a hidden cost of using it for Project A instead of, say, selling it when its value was higher.
Got it. Okay, let's go back to our scenarios and add this layer of complexity. Take the employee who left work for an hour to spend $200 on supplies. The $200 was the explicit cost.
Right.
Now, what if that employee's hourly rate is $25, and that hour could have been spent on billable client work?
Now we're getting to it.
The implicit cost of spending that hour buying supplies is the $25 in potential earnings that they sacrificed.
That $25 is the opportunity cost of that hour of labor. The company didn't write a check for $25 to the ghost of lost productivity, but that potential revenue is gone forever. It's a real economic loss.
And what about the malfunctioning printer? The explicit cost was the repair bill.
Sure.
The implicit cost, though, is much harder to measure, but it's often much, much higher. It's the total production time that was lost.
Yeah.
If that printer serves a manufacturing line that usually processes, say, $1,000 worth of output every hour, and it's down for 4 hours,
Then the implicit cost is $4,000 worth of foregone marginal revenue. It dwarfs the repair bill.
the classic, really relatable anecdote here is the small business owner.
Oh, this is the perfect example.
In the early years, they often pour thousands of hours into their new venture. They forego a regular high-end salary, and maybe they even use their own basement or garage as office space.
Right. That foregone salary, the income they could have earned working for someone else, is the implicit cost of their labor.
And the rent they could have charged someone else for the use of their space is the implicit cost of their own infrastructure.
Exactly. And if they ignore those implicit costs, their business looks highly profitable on paper. Their wages expense is zero, their rent expense is zero.
They think they're crushing it.
They do. But the moment they factor in the lost opportunity, that salary they sacrificed, the economic picture can flip completely. It can go from a positive profit to a substantial loss.
And that's why understanding this dual nature of costs is really the gateway to understanding efficiency. If you don't account for the implicit sacrifice, you are just deceiving yourself about the economic viability of your actions.
You really are.
So, with the distinction between explicit and implicit costs now clarified, we need to take a quick step back before we get into the applications.
Okay.
Because to use opportunity cost effectively, you really have to know what it isn't.
That's a critical point. So many people muddy the strategic water with concepts that serve completely different purposes.
Right. There are these distinct economic concepts, sunk cost, marginal cost, adjustment cost, that are often confused with opportunity cost, but they relate to different phases of decision making.
We need to draw a clear line between true opportunity cost and these common misrepresentations. Let's start with sunk costs. They're often called historical costs.
Right.
The definition is very straightforward. These are expenses that have already been incurred and are unrecoverable.
The classic personal finance trap. You bought a non-refundable plane ticket that you now dread taking.
Or an annual gym membership you never use.
Exactly. That money is already gone. It's in the past. It's sunk.
And that is the crucial implication. Because sunk costs remain unchanged, regardless of your future action, they should logically have zero influence on any present or future decisions.
So all your decisions should only be based on future expected benefits and costs.
Only. But humans are terrible at this. We commit what's called the sunk cost fallacy all the time.
Oh, constantly. I force myself to finish a boring movie or read a terrible book simply because I've already invested 3 hours into it.
That's the psychological friction. But rationally, those 3 hours are lost regardless of what you do next. The only variable you still control is the next 3 hours of your life.
So by forcing myself to continue, I'm just compounding the error.
You are. You're adding an additional implicit cost of 3 hours of wasted time and displeasure. The money for the movie ticket is lost no matter what, but the opportunity cost of finishing that terrible movie is the enjoyment you forego from watching the best available alternative,
Or just turning the screen off and going to bed.
which might have the highest utility of all. The past is the past. Decisions should be forward-looking. That's a great rule of thumb.
Okay, so that's sunk costs. Next, let's look at marginal cost. This is another one that's often confused with opportunity cost, but they focus on two totally different scales of decision making.
They do. Opportunity cost is about the choice between mutually exclusive alternatives. Do I do A or do I do B?
Right, whereas marginal cost is about the incremental cost of production. How much does one more unit of my product cost me to make?
Exactly. Marginal cost, or MC, is focused purely on the next unit produced for an existing product line. Mathematically, it's just the change in total cost divided by the corresponding change in output.
It's the increase in your total cost when you increase your output by just one unit.
Just one. The example of building aircraft clarifies this perfectly. Building the very first aircraft involves massive setup costs. All the R&D, tooling, testing, design.
A huge initial investment.
Huge. But once that production line is established, the 100th aircraft benefits from economies of scale and what's called the organizational learning curve.
So the total cost is high, but the marginal cost, the cost to produce that 100th plane, will be significantly lower than the first or second.
Much lower. And the manufacturer is intensely focused on driving down that incremental expense per unit. That's how they maximize their profit margin.
Opportunity cost, in contrast, would ask a totally different question.
A much bigger question, it would ask. If we didn't build any airplanes at all, what is the best alternative use for this entire factory, this capital, and this highly skilled workforce?
So they're operating on completely different planes of strategic thought. MC is about operational optimization. OC is about resource allocation optimization.
Perfect way to put it. Now, our third exclusion is something called adjustment costs. This refers to the expenses a company bears when it has to alter its production levels.
Usually in response to some big market shift, right? Like a sudden spike in demand or a major change in the cost of your materials.
Exactly. So if you run a widget factory and demand for widgets suddenly skyrockets, forcing you to run a third shift and buy new machinery.
All those expenses tied to that rapid expansion are my adjustment costs.
Precisely. They include costs related to acquiring, setting up, and mastering new capital equipment, and also the costs tied to hiring, dismissing, and training employees to modify your production volume. They are the costs of transitioning from one stable operating level to another.
But the sources also broaden this definition. It's not just about volume changes.
Correct. Adjustment costs also apply when a company shifts the nature of its product itself. If a tech company decides to retool its flagship product to compete better.
To add new features, for example.
Right, to enhance competition through differentiation. That process incurs significant adjustment costs. It involves the expense of reassigning capital and labor, adapting the organization's expertise, and maybe even overhauling the entire supply chain.
This helps us see the distinctions so clearly. Sunk costs are the past. Marginal cost is the very next unit. Adjustment costs are the price of organizational transition.
And opportunity cost is the true measure of what you sacrifice for the entire choice.
We have now established what opportunity cost is and what it is not. So now we get to the core of this deep dive. Segment 3. The practical uses. Why does this theoretical concept drive the highest stakes decisions in business, trade, and even government?
This is where we really move from the classroom to the boardroom, because the calculation of opportunity costs is, it's the difference between surviving and thriving.
Let's start with the business world. This is where the divergence between basic bookkeeping and real strategic decision-making becomes, well, it's unavoidable. Here's where it gets really interesting. We're talking about the difference between economic profit and accounting profit.
Okay, so accounting profit is simple. Its only objective is fiscal reporting. It's for stakeholders, for tax purposes, usually done quarterly or annually.
And it focuses only on those tangible, measurable cash flows. Total revenue minus explicit costs. That's it.
Crucially, opportunity costs are excluded. Why?
Yeah.
Because they don't involve a monetary transaction that you can put on a report.
And if you rely solely on that number, on that accounting profit, you can fool yourself into thinking you've made a brilliant strategic decision.
When in fact, you've chosen a path that severely underutilizes your resources.
Right.
Which is why the entire purpose of calculating economic profit is to aid in better business decision-making. And it does that through the vital inclusion of all opportunity costs, both the explicit cash outflows and the implicit value you've foregone.
So this allows a business to conduct a true evaluation, asking, is this allocation of our resources truly cost-effective, or should we be reallocating our capital and our time to the next best alternative?
Let's go back to that simplified example from the source material, but let's really look at the numbers. Imagine a new startup. In its first year, it generates $10,000 in accounting profit.
The owner's ecstatic. They made 10 grand.
They think they're winning.
Yeah.
But we have to factor in the implicit costs. Let's say the owner is a former executive who gave up a $75,000 salary to launch this startup.
Okay, that's a big one.
A very big one. And let's also say they liquidated a stock portfolio that was worth $100,000, which was generating a reliable 5% return, or $5,000 a year, to fund the business.
So the implicit opportunity costs are adding up fast. You have the $75,000 in foregone salary.
Plus the $5,000 in foregone investment return. That's a total of $80,000 in implicit costs.
So when we calculate the economic profit, we take the accounting profit, the $10,000, and we subtract the total opportunity costs.
The $80,000.
The result is a substantial negative $70,000 in economic profit.
And that negative number is the single most critical piece of information for that business owner. It tells them that their decision to start the business was imprudent.
Not because the business failed to generate revenue.
No, it made money.
Yeah.
But because the opportunity costs, the benefits they sacrificed to make that money, far outweigh the profit they earned. That owner is economically worse off by $70,000 compared to their next best alternative.
Which was just staying in their executive job and keeping their investment portfolio.
Right. That negative economic profit provides a powerful, rational incentive for that owner to reallocate their resources, to maybe shut down the business and go back to that $75,000 salary job.
What happens if the calculation comes out to exactly zero?
That's what economists call a normal profit. This is the equilibrium condition. It means the business is covering all its explicit costs and all its implicit costs. All opportunity costs are covered by the total revenue.
So it means the resources you're using are generating exactly as much value in this business as they would in their next best alternative.
Precisely. So if you're making a normal profit, you're perfectly efficient. You have no incentive to leave because you can't do any better elsewhere.
You're optimizing efficiency.
You are. And the pursuit of a positive economic profit is what drives entrepreneurs and markets. It's the desire to earn more than the cost of all your alternatives combined.
Beyond this really foundational distinction, modern finance has started to incorporate opportunity cost into some very high-level performance measures.
Oh, absolutely.
Cool.
Especially those focused on risk management.
Yeah.
We have metrics like risk-adjusted return on capital, or RIROC, and economic value added, or EVA.
And what do those do?
These advanced tools try to explicitly quantify opportunity costs to help businesses manage risk and optimize how they allocate their capital. They don't just ask, did we make money? They ask a much harder question.
Which is?
Did this use of our resources generate a return that sufficiently compensated us for the risk we took and for all the alternatives we had to forego?
And this leads us straight to the critical connection with what's really the gold standard of investment decision-making, the discounted cash flow method, or DCF.
The DCF method is the primary tool for valuing investments, and opportunity cost is an absolutely essential metric of cash outflow in this estimation. It's baked right in.
How does it influence the DCF calculation? I mean, that seems inherently mathematical.
It does so primarily through the discount rate. The discount rate you apply in a DCF analysis represents the rate of return required by your investors, and this rate is heavily influenced by the firm's cost of capital.
Often called the weighted average cost of capital, or WACC.
And WACC is fundamentally an opportunity cost. It measures what your investors could be earning on other investments of similar risk.
So if my company's WACC is 10%, that means my projects have to return more than 10%. Because 10% is the opportunity cost. It's the return my investors are giving up by putting their money with me instead of in the next best equivalent risk investment.
That is it, exactly. If your project A is expected to return 8%, but the opportunity cost of your capital, your WACC, is 10%, then project A, even though it's profitable on paper, should be rejected. It provides a negative economic profit compared to the alternatives available to your investors.
And there was a second point you mentioned earlier, which I think is often missed in basic finance courses. It deals with assets the company already owns.
This is a massive point of self-deception in business planning. It really is. Say a company is launching a new project that requires a piece of land they already own, or maybe a proprietary piece of machinery that's been fully paid for.
So there's no cash outflow needed to buy these assets. The natural inclination is to assume their cost for this project is zero.
Right. But the sources are very clear on this. The cost of that asset must still be included in the cash outflow calculation at its current market price.
Why?
Because that money could have been generated by selling or leasing that asset to a third party on the open market. That potential income, whether it's from a lease payment or an outright sale, represents the opportunity cost of using that asset internally in your own business venture.
So if you fail to incorporate that foregone income into your DCF cash outflow estimate,
You will artificially inflate the project's net present value. You'll end up making an adjustment decision that is economically erroneous, all because you ignored the opportunity cost of an asset you already owned.
it forces you to value your resources, even those you possess, based on their highest market value elsewhere. It's a key defense mechanism against business bias.
It truly is.
Okay, so now let's shift our focus. We're going from micro-level business strategy to macro-level global strategy, international trade.
And what's so fascinating here is that opportunity cost isn't just a part of modern trade theory. It is the absolute foundation of it.
And this theory revolves around the distinction between two key concepts: comparative advantage and absolute advantage.
Let's start with absolute advantage. It's about straightforward efficiency. If country A can produce a laptop using 100 man-hours, and country B requires 150 man-hours to produce the exact same laptop.
Country A has the absolute advantage. They just use fewer resources to do it. They're just better at it.
Right, but absolute advantage doesn't actually tell us where the economic gain from trade comes from. That's where comparative advantage steps in, and is defined purely by opportunity cost.
So what's the definition?
Comparative advantage is defined by a nation producing a product at a relatively lower opportunity cost compared to its competitors.
So they give up less of their alternative resource to make that product.
They give up less. This is the great insight from David Ricardo. A country doesn't have to be the best at something to benefit from specializing in it. It just has to be the one that, for lack of a better term, sucks the least at it in terms of the sacrifice required.
Okay, let's use the classic tea and wool example from the sources and really make the math clear. This is the key insight we want you to take away.
Sounds good. So suppose we have two countries, country A and country B. They can only produce two things, tea and wool.
Yeah.
And let's say each country has 100 total units of labor.
Okay.
In country A, 1 unit of labor can produce either 5 tons of tea or 1 ton of wool. So to make 1 ton of wool, country A must sacrifice making 5 tons of tea.
So the opportunity cost of 1 ton of wool is 5 tons of tea?
Correct. And to make 1 ton of tea, they have to give up 1/5, or 0.2 tons of wool. That's the opportunity cost of tea for country A.
Got it. Now for country B, our sources say country B is generally less efficient. 1 unit of their labor can produce only 0.3 tons of tea or 1 ton of wool.
So for country B to make 1 ton of wool, they only have to sacrifice 0.3 tons of tea.
And to make 1 ton of tea, they have to sacrifice 1 divided by 0.3, which is about 3.3 tons of wool.
Right. The comparison here is startling, even though country A is far better at producing everything.
They have the absolute advantage in both goods, right?
Not quite. They have the absolute advantage in tea, for sure, 5 tons versus 0.3. But in wool, both countries can produce 1 ton with 1 unit of labor, so there's no absolute advantage there. But they still benefit immensely from trade.
Okay, so let's look at the opportunity costs again. For tea production, country A's OC is only zero point 0.2 tons of wool. Country B's OC is a whopping 3.3 tons of wool.
So conclusion number 1 is clear. Country A has the comparative advantage in tea production because of that vastly lower opportunity cost. They give up a tiny fraction of wool to make tea.
Now let's look at wool. For wool production, country A's OC is 5 tons of tea. Country B's OC is just zero point 0.3 tons of tea.
Conclusion number 2. Country B has the comparative advantage in wool production. They sacrifice far less tea to produce a ton of wool than Country A does. This is the genius of the theory. Country B should specialize in wool.
Even though they aren't necessarily a more efficient overall producer.
Exactly. The implication for global policy is just profound. By specializing purely in what they have a comparative advantage in, and then trading for the other product, both countries can consume more of both goods than they ever could have if they tried to produce everything in isolation.
It ensures the most efficient use of resources on a global scale.
All driven by that simple ratio calculation of opportunity cost. It shifts the entire focus from who is better to who loses less.
And that same principle of maximizing resource efficiency scales all the way up to governmental policy and resource allocation. Governments constantly face these incredibly high-stakes trade-offs where opportunity cost has to be quantified.
It has to be. Let's use the example of government spending on a major conflict.
Hmm.
Say entering a war costs the government $840 billion in direct, explicit cost wages for personnel, buying equipment, all the material.
The public naturally focuses on that $840 million explicit cost. It's a huge number.
And rightfully so. But the true price of that war is the opportunity cost. It's the $840 billion that is now prevented from funding any domestic priorities.
That money could have been used to fund healthcare initiatives or to slash budget deficits.
Or provide substantial tax cuts to stimulate the economy. The decision to pursue the war is implicitly a decision to forego those specific benefits. The economic cost is the loss of the best foregone alternative, whether that was a new highway system or better schools.
And just like in business, the implicit costs here cascade long after the conflict is over.
They absolutely do. The implicit costs include the lost output as resources labor, capital are shifted from civilian high-productivity sectors to military production, and more complexly, you have the long-term deferred implicit costs.
Like what?
Decades of mandated veteran health care, future interest payments on the debt incurred to pay for the war, damage to international diplomatic relations. All of these represent foregone future policy options and lost utility.
For a recent and incredibly comprehensive illustration of opportunity costs at the national level, we have to look at the governmental response to the COVID-19 pandemic.
Oh, absolutely. That scenario offers a powerful case study in simultaneous large-scale explicit and implicit costs.
The scale of the economic response was just unprecedented. We saw massive explicit costs. Our sources detail the direct expenses: $4.5 billion on medical bills, over $17 billion on vaccine distribution.
And hundreds of billions more poured into economic stimulus plans. These costs resulted in soaring public debt and, at the same time, decreased tax income as economies slowed down.
But the true toll of the crisis, both economically and socially, really lay in the implicit opportunity costs, the benefits that were necessarily sacrificed to achieve the primary objective of public health containment.
And that includes things like the $158 billion loss that's directly attributed to decreased economic activity from restrictions and lockdowns. But it goes so much deeper than that.
You mean the reallocation of attention and resources away from routine services and toward the emergency COVID response?
Exactly. That meant a massive implicit cost in public welfare. We're talking about delayed cancer screenings, postponed non-emergency surgeries.
The long-term educational loss due to remote learning, which we now know disproportionately affected certain demographics.
These are all benefits or utility that were consciously foregone as a society.
So things like the rise in mental health issues, the loss of social cohesion, the slowed economic growth. These are harder to put a precise dollar value on.
Much harder. But they represent a substantial opportunity cost because the resources, the time, the facilities, the capital that could have been used to maintain or improve those conditions were locked down or redirected. The implicit cost of saving lives through lockdown was, for many, the quality of their life and the integrity of their community.
And this brings us to a specific field where opportunity cost is not just a tool, but an ethical and structural necessity.
Yeah.
Health economics.
Especially when dealing with resource scarcity.
In any health system, and certainly during the pandemic, opportunity cost is central to efficiency decisions. Resources are finite, and every decision to treat patient A means consciously accepting that you may not be able to treat patient B.
During the peak of the COVID-19 crisis, the scarce resources were incredibly stark. We were talking about intensive care unit ICU bed days, ventilation time, therapeutic equipment, and of course, specialized medical staff.
It was a textbook example of supply and demand disruption.
It was. The demand curve for hospital beds shifted sharply to the right because severely infected patients required much longer hospital stays. At the same time, supply often shifted left due to staff shortages, burnout, or the need to decommission beds for contamination control.
So the system was shrinking while the need was exploding. This is the moment where marginal opportunity cost becomes a life and death calculation.
Well, the balance in a perfect competition model is theoretically what we call Pareto optimal, meaning no one can be made better off without making someone else worse off. When resource scarcity hits like that, the system moves away from that optimum and medical allocation decisions must be made. Triage must happen.
So when the system runs out of beds or ventilators, the cost of treating patient A, the explicit costs of their care, is suddenly multiplied by this massive implicit opportunity cost.
The foregone ability to treat patient B, patient C, and patient D, who are now turned away or have their own routine, life-saving procedures postponed indefinitely.
Opportunity cost in this context really measures the true price of that triage decision.
It does. And it forces policymakers and health economists to quantify the utility lost by the entire population when resources are focused entirely on one crisis. And hopefully that ensures that future resource allocation strategies are based on the highest utility for the greatest number of people.
This has truly been a deep dive. We've moved from the most basic concepts of accounting to the highest stakes decisions in medicine and geopolitics.
I think to synthesize the core message for you, it's this. Opportunity cost forces us to engage in critical thinking. It forces us to quantify not just what we paid in explicit dollars, but what we gave up in implicit value.
It shifts the entire focus from simple reactive accounting
To proactive, comprehensive economic profitability and resource efficiency. And that's true across all domains of life.
We reviewed three major areas where this concept is just indispensable. First, in developing better, more honest business strategy by calculating true economic profit.
In its critical role in the DCF valuation model.
Second, enabling smarter global trade policies by specializing in comparative advantage, which leads to greater global consumption.
And third, making those high-stakes governmental policy choices clearer by forcing an acknowledgement of the vast, long-term implicit costs of something like a war or a pandemic response.
So what does this all mean for you, the listener, right now?
It means that every decision you make is an optimization problem. If time spent researching and managing information is an implicit cost, then you are constantly giving up a potential return on that time invested.
Whether that's earning money or spending time with family or just engaging in leisure.
That lost utility is the cost of not being well-informed. The challenge of opportunity cost is that it is always there, whether we choose to ignore it or not.
I think it's always there.
The final provocative thought I want to leave with you is this. If the average human being makes dozens of significant high-impact decisions every single day, career choices, personal time allocation, investment risks, and we've just seen that negative economic profit is driven by high opportunity costs, how many of your daily decisions result in a negative economic return? I challenge you to consider the true price of your attention, your time, and your limited capital purely through the lens of maximizing foregone utility. Are you spending time on the best possible use of that limited resource, or are you paying too high an opportunity cost? That is the true measure of efficiency.